Competition for trading volumes between alternative trading platforms has seen the proliferation of rebates for liquidity provision, so-called maker-taker pricing. Market efficiency requires that venues maintain an appropriate balance between liquidity suppliers and liquidity takers. The challenge for alternative trading platforms has been to encourage liquidity and gain market share. One way in which this can be effected is through the structuring of trading fees. On November 1st, 2013, the TSX introduced significant changes to their fee structure for stocks priced below $1. This change saw a shift from a maker-taker model to a symmetrical pricing model, with both makers and takers of liquidity required to pay a fee. With liquidity providers on TSX being charged rather than rebated, for these stocks, this could lead to lower levels of liquidity on the TSX, especially if liquidity providers abandoned the TSX for another Canadian market, which maintained the pre-existing rebate system. Using the market quality dashboard, we analysed the impact of this fee change on the TSX and other venues in Canada. To construct this analysis, we first needed to create groups of appropriately priced stocks. If we select the Groups tab, we can see that there is an option to construct and edit security groups through the Manage Groups button. For this analysis, two groups of securities have been pre-constructed. The first group consists of all securities that trade below $1, while the second group consists of all stocks that trade between $1 and $2. We also select a time period of 2 months either side of November 1st. Looking to see if there has been any migration away from the TSX to Chi-X, its major competitor, we first choose Trade Value. We can easily see that while there does not appear to be a significant change in the value traded on TSX, there does appear to be a modest increase in the traded value on Chi-X for stocks priced under $1. Without observing a migration of traded value between the two markets, we would not expect market efficiency to be affected. We can easily examine this by selecting a proxy for transaction costs, such as effective bid-ask spreads. We observe no real change in spreads on TSX vis-a-vis Chi-X and Alpha, although there does appear to be a general trend increase across all three venues in bid-ask spreads. As a liquidity flight from the TSX would translate into an increase in spreads for that venue and reducing it in others, it is likely that the increase is just seasonal. With a lack of any significant change in transaction costs, it would appear that market efficiency was unaffected by TSX move to a symmetrical pricing model for securities priced below $1. To be sure, we should also look at a proxy for price discovery. Looking at price discovery or price impact, we see no precipitable change in price discovery around the introduction of the rule. This holds for both groups of securities. Contrary to expectations, with no distinguishable change in transaction costs or price discovery, it would appear that the change in trading fees has not adversely affected the liquidity on the TSX for stocks trading below $1. This may be because of the very high market share that the TSX enjoys, which would limit the ability of liquidity to migrate for these stocks. Furthermore, as these securities have relatively low market capitalizations, they are not as attractive to high-frequency traders, who are most likely to be sensitive to changes in rebate fee structures.